Thank you. Good morning. I'd like to make this very interactive. My preference, even though it's part of my job, is not to give long, formal speeches where I read long statements to you and put you back to sleep. Excuse me. I would love to just have a conversation with you about the Federal Reserve, what we do, what we're looking at, what we're seeing in the economy, and then very importantly, hear from you. And if you, as Aaron said, if you could ask me your toughest questions, I would appreciate it, because that maximizes the chance that I'm going to get to learn from you and take that back into our policymaking process. Now, I'd like to start by just level setting. A lot of people don't know this, and I didn't know this before I went to Washington, sorry. Why is there even a Minneapolis Fed at all? So if you go back in our country's history, our country hated the idea of having a central bank because it seemed mysterious, and it seemed like all this power was concentrated in these select few individuals. So Alexander Hamilton created our first central bank. It lasted about 20 years, and then eventually it was disbanded. And then in the 1800s, our country kept having financial crises, booms and busts, and yet Europe was not having the same frequency of financial crises. So people ask, why is that? Why is our economy so vulnerable to financial crises? One of the reasons is we did not have a central bank to be that stabilizing force, that lender of last resort. So in 1913, Congress created the Federal Reserve System. But again, they still hated the idea of having all of this power concentrated in a few hands in Washington, D.C. So they did something unique. They distributed it. So that's why we have a board of governors in Washington, D.C. with 7 representatives that are appointed by the President of the United States. And we have 12 regional Federal Reserve banks scattered around the country. And the presidents of those reserve banks, I'm one of them, are appointed by a local board of directors. And we report to that board of directors. And then together, the 12 presidents and the 7 governors in Washington ultimately set monetary policy for the country. So it was a compromise. It was a way of saying, if we have to have a central bank, let's have it distributed, let's have it more directly represent you, represent the people, represent our communities, rather than just being concentrated in Washington, D.C. So, we are a little over 100 years now. The Minneapolis Fed has been here. As Aaron said, I'm the 13th president of the Minneapolis Fed, have been here for just a little over a year. I was born and raised in Ohio. I studied at the University of Illinois in Urbana, done a bunch of different things, as Aaron said, and then I'm happy to have joined the Minneapolis Fed and moved to this community about a year ago. My only disappointment, people always ask me, what's disappointed me? My only real disappointment in Minnesota so far is how lame your winters are. I was told I was ready for bracing, brutal Minnesota winters. It hasn't happened yet, but I'm crossing my fingers and I like the cold, looking forward to it. So let me just talk a couple of the big policy issues that I've been focused on since I joined the Minneapolis Fed, and then we'll open it up to you. And we'll hear what's on your mind, what questions are most interesting to you, and I'll do my best to try to answer them. One of the things that I did when I was at Treasury, so I was at the U.S. Treasury Department during the financial crisis. I was one of the first responders dealing with the collapse of the financial system. And the height of my notoriety or fame or whatever you want to call it was when I was the guy who bailed out the banks. So I ran the TARP program, and we hated it. We were a free market Republican administration. We wanted to let the markets work and let all those banks fail. The problem was if we had allowed the financial system to collapse, instead of the Great Recession, we would have been looking at the Great Depression. And so Republicans and Democrats came together and said, no, we can't let that happen. We need to step in, not for the bank's sake, but for everybody else's sake, and stabilize the economy. And I'm proud of the work that we did under both Presidents Bush and President Obama. And importantly, our program, which was authorized up to $700 billion, your dollars, got all the money back. And we even made a profit off of the bank investments that we had made. And so that was a terrible situation, but we made the best of it. But when I got to the Minneapolis Fed, one of the things I found was that this bank has done work for the last several decades on the issue of too big to fail. And when I got to the bank and I started talking to the experts here, and I said, what do you think about the too big to fail problem? Do you think Dodd-Frank has solved it? The answer was a resounding no. And I said, that's interesting, because I don't think so either. So let's see what we can do. So beginning a year ago, we announced a major initiative to take a fresh look at the issue of too big to fail. Has Dodd-Frank, have the new regulations really solved the problem? And if not, what can we do about it? So over the course of the last year, we brought the best experts in the world to Minneapolis to help us look at these issues. We heard all perspectives. By the way, all of these conferences that we had and the materials, they're all on our website. So they were all live streamed to the public so anybody could follow along. And we learned from those discussions, the big banks are still too big to fail. And if one of them ran into trouble today, don't kid yourself, the taxpayers would still be on the hook. Because if that bank were to collapse, it would cause so much damage to so many other institutions, to your clients, throughout the U.S. economy. And so that's an issue that I still think is a big problem. Now, we've come up with a solution to it. We call it the Minneapolis plan that substantially raises the capital requirements of the biggest banks. A giant bank is a little bit like a nuclear reactor, right? If a nuclear reactor, think about Fukushima in Japan, if a nuclear reactor melts down, it's devastating for society. So if a nuclear reactor starts getting into trouble, governments will do whatever they can, spend whatever it takes to try to stabilize that nuclear reactor. Same thing with the big bank. And so what do? We could either outlaw nuclear power, or we could regulate it so stringently that you really minimize the risk of getting into trouble in the first place. And that's what I think we need to do with the biggest banks in America, make them issue so much capital, 20+% equity, so that they virtually can't fail. Now, by the way, there's a interesting symmetry that I figured out through this process. You know, when I moved to Minnesota, my wife and I bought a house, and I had to apply for a mortgage, which was an absolutely brutal experience, okay? Going through the mortgage process. If you've done it lately, man, you don't wish that on anybody. But the bank made me put 20% down. And why did they do that? I had to put 20% down to protect the bank in case I ran into trouble. So funny thing is, if we as taxpayers make the biggest banks put 20% down, we can more or less basically address the too big to fail risk. Now, they don't want to, because their profits will go down, their return on equity will go down, their share prices will go down. Too bad. All right, that's not our problem if they don't have business models that work without the taxpayer standing behind their banks. And so we're going to keep pounding on this drum. We're going to keep getting the message out that the too big to fail problem still exists, but there are real solutions that are fairly simple and straightforward that can really address it. It literally is just about as simple as putting 20% down. You do it on your house. If we make the big banks do it, the U.S. economy will be a lot more stable. So that's been a big issue that we've been focused on, and happy to talk to you about that. A second one, more recently, my biggest disappointment coming to Minnesota is how, I talked about the weather. One of the biggest surprises to me was, as well as the state is doing in so many dimensions, overall education level, diversity of the economy, low unemployment rate, we have some of the worst racial disparities in the country. Now, I didn't expect to see that. I didn't know about it until I got here and started traveling and visiting different communities across the state and across the region. And the more I asked questions about why is it, what are the root causes of these issues, I didn't find very good answers. And I started talking to people nationally. I didn't find very good answers. And so about a month ago, we announced a major new research institute at the Minneapolis Fed called the Opportunity and Inclusive Growth Institute. One of the things the Fed is very good at is economic research. We've got hundreds of PhDs all around the country working on important economic issues. Well, I think it's high time that we focus a lot of this brain power on understanding the various gaps in our society. And so we've just announced this institute. We're, again, bringing some of the best experts from around the country to Minneapolis to help us study these issues. These issues are long in the making, decades or longer in the making. We're not going to come up with an answer in a year or so, but we need to get going. We need to do the research to understand. I'll give you an example. Across the country, white unemployment is typically half that of black unemployment, in good times and bad. So if it's a booming economy and white unemployment is 4% in America, there's a very good chance that black unemployment will be around 8%. If it's a recession, a deep recession, and white unemployment is 8% in America, black unemployment will probably be around 16% in America. And we don't know why that is. We don't know what the structural factors are. At first I thought it was education, but as you dig into it, if you take African American versus Caucasian college graduates, the same gaps exist. It's striking. And we need to understand why these gaps exist. What are the structural factors if we hope to close them? And so this is another major priority now for the Minneapolis Fed to target a lot of our really smart PhDs Let's do the research. Let's understand the issues. Even if monetary policy cannot solve the problems, if we can understand them and present our findings to the public, then potentially other policymakers, fiscal policymakers, state legislators, governors, mayors, the U.S. Congress can pick up the mantle and take it from there. And so we're going to do that work. So those are some of the priorities in the first year that we've been focused on. A lot more to do. I think the Minneapolis Fed is a remarkable institution. We've got a wonderful research department, great staff, about 1,000 employees total, and I'm looking to get us engaged on the most important economic issues and challenges that we face as a country. And if we can make progress, we want to do so. That's why we're here. Do as much good as we possibly can and be open and transparent to all of you so you know what we're working on and you can give us feedback as we move forward. So with that, I would love to take your questions. Don't be shy. Ask me anything you like. Offer me. One time I gave a speech before I joined the Fed. It was about the financial crisis. And the first person in the audience raised his hand and said, I want to thank you for your service during the financial crisis. I think you guys are heroes for tackling it. I said, thank you. It was very nice of you. The next person raised his hand and said, I think you're a bum. I disagree with that guy. I hated the bailouts. That's fine, too. So anything is fine. So with that, anybody have questions in the front, you can raise your hands. Yes, sir. And I'll repeat the question.
Thank you, because I don't have all my voice today.
Okay.
Good. One of the fallouts of Dodd-Frank has been the rise of a lot of non-bank lenders. If you start throwing additional capital requirements on banks, are you actually encouraging the rise of non-bank lenders, or doesn't that have a lot of other effects?
Yep, great question. So the gentleman said one of the consequences of Dodd-Frank was that you're seeing the rise of non-bank lenders. And if we just raise capital requirements on the biggest banks, are we just going to push that activity to shadow banks, hedge funds, other non-banks? That's exactly right. And I skipped over some important parts of our plan. One of the components of our plan is we introduce a tax rate on the debt of non-banks, on shadow banks, to equalize the cost of funding between banks and shadow banks. So if you have a hedge fund and you don't use debt to fund your investments, you don't pay any tax, you're fine, you're 100% equity financed. But if you load up on debt to fund your investments, the last thing we want is all of the activity moving from some giant bank to your hedge fund. So you will end up then paying a tax on the debt, which will equalize the cost of funding between the big banks and the shadow banks so that we don't push all the activity there. So I'm with you.
Does that affect leasing companies, for instance?
Does it affect leasing companies? I need to go back. I don't remember all of the details of exactly who it applies to, but it's there on our website. There's a 50-page document which walks through it.
It sounds great when you say hedge funds, but the shadow bank.
I know shadow banking is much broader than just hedge funds. I'm just using them as a representative sample. But the core of your point is right, which is if you just do one thing, jack up capital requirements on the biggest banks, and it pushes activity to non-banks that are not subject to the capital requirements, have we improved safety? I think the answer is no. So you do want to have a level playing field, and we come close to achieving that. Thanks for your question. Yes, sir.
At this point, what tools do you have to prevent another bust in the economy?
At this point, what tools do we have to prevent another bust in the economy? Well, it depends on what you mean by bust. So truthfully, this is one of the things that I wrestle with a lot. So I'm going to take a step back. We have what's called a dual mandate, which Congress has given us, which is stable prices and maximum employment. And many central banks don't have a dual mandate. Many central banks simply have price stability, low inflation as their target. Well, really, we have a third mandate. And the third mandate is financial stability, which is the core of why we were created in the first place. And the tough thing happens is what happens if we see financial instability rising when prices are stable and maybe there's still slack in the job market? Are we going to raise interest? People ask us, are we going to raise interest rates to quash what we think is a bubble when inflation is low and maybe there's still some unemployment there? And people will point to, leading up to the housing bubble, like 2004, 2005, should the Fed have jacked up interest rates if they knew that there was a housing bubble? This is really tough because it's almost impossible with any certainty to see a bubble in advance. It's obvious it's a bubble after it crashes, but on the way up, it's very, very difficult to recognize. And as evidence of this, I think it was 1996, then Fed Chairman Alan Greenspan uttered those famous words, irrational exuberance, saying the stock market was overvalued. Well, what has the stock market done since 1996? Done this. So what if Alan Greenspan said, no, I know it's a stock market bubble, and I'm going to jack up interest rates until I keep those stock prices down? Boy, he would have triggered a huge recession to try to keep stock prices from going up. So I'm just giving you a flavor for how tough it is for a regulator to say, I know there's a bubble when nobody else sees it. And people will get really upset at that regulator. Maybe that's okay, but it's very, very tough stuff. So what we look at is we're keeping our eyes open for asset prices to try to look for signs of bubbles. But as importantly, we're looking for what is funding those assets. If it's debt funding, it's much more dangerous than if it's equity funding. So you all lived through the tech bubble and bust, many of you did, in the late 90s in 2000, 2001. That did not trigger the Great Recession. Triggered a small recession. Didn't trigger the Great Recession. Why? Because your clients couldn't put 90% debt under their stock purchases. At most, they were margin 1-to-1, right? So there's not much debt underlying these equity investments. So if the stock market comes back down, if there's a correction, it's not likely to cause the kind of chaos that we saw in 2008, as opposed to housing, where people were levered up 5-to-1, 10-to-1, 20-to-1, in some cases put nothing down. And so it's that debt underlying the asset class which is what makes bubbles bursting so damaging. So we are keeping our eyes open for different potential bubbles, and most importantly, we're looking for the debt underneath them and seeing what we can do as regulators if we see that debt accumulating to try to slow it down. In the back. Oh. So how do I feel about the Fed's balance sheet? Does that give me concern? And what do some of the negative interest rates around the world say about markets? So let me go back and explain why the Fed did what's called QE, quantitative easing, in the first place. If you look at, there are different rules of thumb for monetary policy that look at inflation and look at what's called the output gap, how much unemployment, how much spare capacity there is in the economy. The most famous of those rules is called the Taylor rule, which you may have heard of before. Well, when the Great Recession hit, interest rates are supposed to balance savings and investment. When the Great Recession hit, the economy was demanding, and those rules were calling for deeply negative interest rates. Could be negative 3%, 4% or more interest rates. Now, we couldn't do that. The Fed couldn't do that. So they said, well, if we can't do that, are we out of ammunition? And Ben Bernanke, then chairman of the Fed, said, no, we're going to use quantitative easing to drive down long-term interest rates. Long-term interest rates here are what are critically important, because as you and your clients make investment decisions, you're not just investing overnight. You care about what interest rates are going to be over the next 5 years, over the next 10 years. So when we at the Fed adjust short-term interest rates, we're sending you a message about the path of long-term interest rates. That's ultimately what affects the economy. So once the Fed was already at zero, they said, well, let's buy longer-term bonds to try to drive those long-term interest rates down directly. That was the idea behind it, and I think it was the right thing to do. So now we have north of $4 trillion on our balance sheet, and we're reinvesting those proceeds. Our plan has been, it's been said publicly, so this isn't news, is that at some point, once the economy is strong enough, we will taper or then stop the reinvestment of those proceeds. So right now, we're keeping the balance sheet static, and as bonds mature, both mortgage-backed securities and U.S. Treasury bonds mature, we're reinvesting them right now to maintain the size of the balance sheet. The current plan is, at some point in the probably not too distant future, we would stop the reinvestment and let that portfolio slowly taper off over time, over several years. So personally, I feel like this strategy is a good one. I think it has a high probability of working and being an orderly transition from a very large balance sheet to a more normal balance sheet. It probably won't be as small as it was before because the U.S. economy continues to grow, but it will be smaller than it is today. So I'm not too concerned about it. It feels like things are well underway. What was the second part of your question? Negative interest rates. So what's going on with negative interest rates? Let me also take a step back. Central banks, like the Fed or the ECB or the Bank of Japan, what we are doing is fiddling around with interest rates over the short term around a long-term trend. So the long-term trend of real interest rates all around the world since around 1980, 1981 have gradually fallen like this to now where in some countries they're negative. That is not happening because of central banks willing that to happen. That is happening largely because of broader macroeconomic forces, things like demographics, things like productivity development, things like global trade and investment flows. As these things are moving back and forth, the interest rate necessary for savings and investment to balance has been gradually reducing over time. That's not because of Fed policy, ECB policy, or Bank of Japan policy. It literally is because of broader macroeconomic forces. So when you have this trend doing this, the Fed is simply moving up and down around that trend, trying to manage the spikes and the lows in the economy. But that trend is driven by broader macroeconomic forces. And so what do we need to get that back up again? We need better productivity growth. We need things like population growth. Like, where does economic growth come from? It comes from population growth and it comes from productivity growth, basically. And so our populations in the US and in Western economies, advanced economies, they're not growing nearly as fast as they used to. Partly because we're having far fewer children, and partly because immigration, at least in the US, immigration has slowed somewhat. And so if we want to get economic growth up again, we need more productivity growth and we need more population growth. And that's just math. And so it's up to all of you and the public to decide, how do we achieve that? The Fed can't do that. The Fed cannot affect population growth. The Fed cannot directly affect productivity growth. And so those are the big conundrums of why has productivity growth been so slow over the last decade and more than that. And that's certainly a contributing factor to this low real interest rate environment. Sorry, long answer to your question. Over here, yes. Your mic's off.
Two of them. Two questions. One, if the goal is 20% reserve for the banks, what are they at now, and how does that compare with their international competitors in Japan and Germany and whatnot, who are also competing for the business? Second question is, with interest rates at 30-year lows here, does it make sense, or is somebody talking about rolling our short-term government debt over into longer-term maturities?
So the banks, the big banks I'm talking about, top, we set for our plan banks 250 billion of assets and above, which is about a dozen or so banks in America. They have about half the equity they need right now. They need about double what they have right now. And European banks have even less. And one of the challenges we have is that Europe seems very comfortable having too big to fail banks. They're their national champions, and if they have to bail them out every 20 years, so be it. That's the price you pay for having a national champion. I don't find that very comforting. And I don't think that that's a good answer for our country. Just because they want to take huge risks with their economy and their financial systems, I don't think that means we should. And I'm hoping that if we can lead the way and show the world, hey, you know what, you can have banks that are safe, you can have a vibrant economy, we can show other countries that they should follow our lead. So I don't think we should wait for Europe, because we'll be waiting forever. What was the second part of your question?
With interest rates at 30-year lows, doesn't it make sense for the government to take their long-term or convert short-term maturities into longer-term maturities before interest rates start up again? Yeah,
so that is purely a decision of the U.S. Treasury Department, not the Federal Reserve. So the debt issuance is done by the U.S. Treasury. They have an Office of Fiscal Service, which issues, whether it's overnight debt or 10-year debt or 30-year debt, et cetera. And so they're managing that debt profile. I'll tell you, there are two schools of camp, or two camps, whatever, two schools of thought. It's too early in the morning. Two schools of thought on this. On one hand, people say exactly what you said. Let's sell as much long-term debt as possible, and let's take advantage of these low borrowing costs. There's another school of thought that says, hey, if we were to fund long-term all right now, we're going to be paying much higher interest rates, not taking advantage of the short-term rates. And so you're paying every year a little bit of extra cost for that added safety. And so I think what Treasury is probably trying to do, I haven't talked to them directly about it, is they're probably trying to find a balance between those two different views. Because if you just funded everything very long right now, the U.S. budget would be much more constrained than it is taking advantage of the even lower short-term rates than they have. So I think they're probably trying to find a balance. But I'm with you in spirit of what you're saying. Oh, go ahead. Yes. Hi there.
In terms of unemployment, given the research that you do and your mandate on unemployment, do you feel that if the economy sped up, that we'd find all sorts of people entering the workforce that haven't today?
Well, we've been seeing that for the past year and a half. It's been a big surprise, a positive surprise. One of the thoughts coming out of the Great Recession was that you were going to have permanently higher levels of unemployment, and that a lot of workers who lost their jobs during the recession became long-term unemployed, and then they became permanently unemployable. You know, their skills would atrophy, the economy would move on, and you'd have this huge cohort of people who were just out of the labor force, which is tragic. Fortunately, that's not been happening as much as people thought it would. And as the last year and a half, something very interesting has been happening. The U.S. economy has been creating jobs at around 180 or 200,000 per month, which is faster than is needed to keep up with our population growth rate. We need anywhere between 80, 100, 120,000 jobs per month to keep up with our population growth rate. Yet the economy's been creating 200,000 jobs a month. So that's an extra 80,000 jobs per month. And what's been happening? You would have expected to see the headline unemployment rate dropping very, very quickly because we're using up all of those workers. Well, it turns out we're bringing people off the sidelines who are not counted in that unemployment rate. And so the unemployment rate has been basically stuck at around 5, 4.8, bouncing around there. Meanwhile, the job market continues to stay strong. And so exactly what you just said has been happening, and I'm cautiously optimistic there's still more room to run. One of the big questions we are wrestling with as we think about interest rates is how much slack is left in the labor market. We know the headline unemployment rate, which is right now around 4.8 or 4.9, does not tell the whole story, because that does not capture the fact that some workers are stuck in part-time jobs and they want full-time work. Some workers have given up hope and have left the labor force altogether. So we look at many other measures of unemployment to capture those workers. So for the last year or two, more workers have been re-entering or not leaving the labor force than we had expected, which is a good thing. I think that process has some more room to run, and we're watching it like, laser eyes, trying to figure out how much slack is left in the labor market. Yes, up here. So within our region around here, what are the strengths and the weaknesses? So by the way, the Minneapolis Fed covers Minnesota, North and South Dakota, Montana, Upper Peninsula, Michigan, and part of Wisconsin. So a big part of my job is traveling the region to get to know it, to see what the strengths and the challenges are. There are a lot of strengths. First of all, this is a very diverse, in terms of sector, very diverse economy, with most of the major sectors of the U.S. economy represented here, whether it's ag, manufacturing, healthcare, services, mining. All the major sectors are represented here, and that's a strength, because at any given time, some sectors are going to be doing better than others, and I think overall we benefit from the fact that we have that diversity. Now, if you look around our region, some of the challenging areas are those in export markets. With the strong dollar, it's up about 20% in the last couple of years, has been challenging. Ag prices, in most cases, have been somewhat low. Commodity prices have also been somewhat low. In North Dakota, obviously big exposure to oil, not nearly as strong as it was a couple, 3 years ago, but better than it was a year ago. Oil prices back up around $50. So I think overall our region is doing quite well. I don't think, the challenges that we do have in terms of the sectors that are under pressure right now, you're always going to have some sectors under pressure, right? It's almost impossible that every one of the sectors in our region is all going to be booming at the same time. Very unlikely. So overall, I think the economy is doing quite well here and as we think about us relative to our country.
Yeah, we have a question right here.
Yes.
I believe Janet Yellen said that she thought interest rates would rise by 2% by 2019. And I had always thought that the Fed's target was keeping inflation under 3%. And just given how it's been running, it seems to me that from a small business perspective, you might be better letting small business spend their money on wage growth as opposed to raising interest rates and spending it on higher borrowing costs. If you were a voting member right now, would you be voting for interest rate increases currently?
Well, I am a voting member right now.
Okay. All right.
So let me there's a lot involved in that question there. First of all, let me say this. I have a personal policy of not making predictions about the next interest rate hike and making forecasts. And the reason is because we have 17 people at the table. And if you have 17 people making predictions and making forecasts, it just adds a lot of noise and a lot of chaos. And I don't think that does anybody any good. And so a couple of weeks ago, I published a long essay on our website looking at why I voted in January to keep rates steady. And I went through all of the factors in a backward-looking way that I looked at to say that the current level of interest rates was appropriate in January. So number one, I would ask you to look at that because it kind of goes through it all in detail. Number two, a couple just nits. Our inflation target is 2%. So that's what we and most central banks have adopted, but we've adopted it formally as our target. We're right now at around 1.7%. And there are different measures of inflation, but the one that we look at is called PCE, or personal consumption expenditures. So we're coming up a little bit short on our inflation target. And as I was chatting or just answering the question from the woman a few minutes ago, I still think there's some slack left in the labor market. And those are the two things that I think are most important in achieving our dual mandate of stable prices and maximum employment. We have seen wages come up a little bit in the last year. I agree with you, that's a good thing. They're not yet to levels that are alarming. They're not yet to levels that they were before the Great Recession, so in the 2006, 2007 timeframe. So hopefully, I'm with you, hopefully wages can continue to climb for American workers. We want the U.S. economy to grow as quickly as it can, strong, robust, long-term economic growth, so long as we keep inflation in check. And so, we're going to watch inflation very carefully. We're going to watch the labor market for signs of potential overheating, but we want the economy to go as fast as it possibly can. We don't want to be the ones holding it back. Yes.
Thank you for your decision to use Fed resources to take a look at the issue of economic inequality. I'm curious, within the dual mandate of the Fed, how far you think you can go with that research, and knowing that the solutions to a lot of those issues can get into partisan politics pretty quickly, how far do you plan to go, and do you think you can go with actually putting forth policy solutions on those issues?
Yeah, it's something that I am very aware of and sensitive to. So Congress gave us a mandate. One of our dual mandates is maximum employment. That means as many Americans working who want to work as possible. And so for me, that means us understanding what are the structural factors keeping some people out of the job market is well within our mandate. Now, so we'll do that research. And as I indicated earlier, it's likely that we don't have the tools to actually address these problems. I don't think monetary policy, we have to set one interest rate for the whole country. You can't target certain communities or certain groups. So monetary policy probably cannot address it. But if we can do the research in an analytical, honest, rigorous way, put our findings forward, then let the elected representatives take it up or not, that's on them to decide what ultimately to do with it. We just feel like we have to do our part, which is doing the research, presenting our findings objectively and honestly, and I think we'll be fine. I think we need to do that, and we will. Others? Yes, sir.
So there's been an audit with that bill in front of Congress for a number of years, and if this Congress is able to get that passed, can you tell us what you believe are the pros and cons of that happening?
So the question about the audit the Fed bill, been a bill pending in Congress for many years. If it were to pass, what are the pros and cons? I don't see a lot of pros. So the Fed is highly audited already. So let's just start. Our balance sheet, all of our financial transactions, all of these are audited by external auditors. We have multiple layers of auditing going on. Internal audits, external audits, the big four audit us, et cetera. So those kind of audits go on all the time. And they're all publicly available. You can download them and read annual reports, if you can't sleep at night. So the part that they're talking about is auditing our monetary policy decisions. And we are strongly opposed to this because we feel like it would politicize the Fed. One of the great miracles in economics over the past 30 or 40 years is how important this independence of a central bank has become. Because one of the reasons that our interest rates are so low, one of the reasons that our borrowing costs are so low, is that the public, the investing community, the American people, investors around the world, have confidence that the Federal Reserve is not going to be whipped around by short-term partisan politics in setting interest rates. That we're going to focus on our dual mandate, and we're going to take it seriously, and we're not going to let inflation get out of control. And because people have come to trust that, it's a self-fulfilling prophecy. People have confidence that inflation will stay low, then they don't demand higher rates of return on their investments because they're not worried about inflation. And so protecting the Fed's independence is actually an enormously important thing, and that's why we're opposed to auditing the Fed. Now here's why would an audit be bad? Imagine if you have decisions to make. Let's say you're a member of Congress and you have to cast votes every year. Some of your votes are easy. Some of them are tough. Some of them, you have to talk to a lot of different experts. You talk to a wide range of your constituents. You have a lot of analysis, a lot of back and forth with your staff. Now imagine, and you, as that elected representative, you put all of that together in your head and you make the best judgment you possibly can. Now imagine if you knew that the day after you cast that vote, an auditor was going to come in and write a report on whether or not you made the right decision. They're going to look at all the analyses you looked at, all the back and forth with your staff. They're going to look at who'd you talk to, why'd you talk to this person, why didn't you talk to that person, and then write a report. Is that going to make you a more effective or less effective decision maker? It'll make you a less effective decision maker because you're going to think twice about who you talk to. You're going to think twice about what analyses you look at, and it's going to make you less effective. So I'm saying to you, and I think everybody at the Fed would agree with this, hold us accountable for the results that we achieve. The dual mandate that's been given to us is stable prices and maximum employment. And then let us worry about who we're talking to, what analyses we look at, so that we can consult as wide a range of people as we can, put that together in making our decisions. Hopefully I answered your question. In the back?
Hi, so not trying to put you on a political spot, but I like the thought about the 20% for the banks. We're at a new administration that is at least trying to change the regulatory environment, correct? So for every one new, take away two. So maybe your thoughts from your position on that stance and what that looks like going forward, especially for the banks, and maybe for your, if the 20% is a regulation put in place, what are two things that you might take away?
Sure. Well, part of, again, I skipped over our plan just in the sake of being brief. Part of our plan is higher capital for the biggest banks and relax regulations for community banks. Because right now, Dodd-Frank has been a very broad brush. And while it's been trying to address too big to fail in the biggest banks, it's actually had effects on just about all the different banks and created a lot of burdens. My own experience trying to get a mortgage, I wrote an op-ed last week in the Wall Street Journal about it, how brutal it was to get that, needlessly so. And so if we can make sure that we've really taken care of the biggest banks and the risks that they pose, I think we could relax a lot of regulations on just about everybody else so that people are freer to run their businesses, to make the investment decisions that they think are right. We all would then have confidence that the biggest banks are safe and not so micromanaged. So I think it could be consistent with the spirit of where the administration says they're going in terms of regulations. But I certainly would be against just blindly rolling everything back because I do think the biggest banks are still a risk that we face today.
So I just wanted to say thank you for your service, especially on the financial services crisis.
Thank you.
And those were pretty crazy times for all of us, especially here at you. So what's keeping you up at night right now as far as bubbles on the horizon, other than the big banks?
What's keeping me up as far as bubbles on the horizon? I mean, we all look at stock markets reaching new highs. We look at commercial real estate, which in some parts of the country is pretty expensive valuations. So those are things that are always concerning. And then there's always concerns about the crises come from places you're not looking. this is a true story. So I went to Treasury in 2006 when Hank Paulson became Treasury Secretary. And as soon as I got there, I started with him the same day he started. He said, we are due for a financial crisis. I remember this. Not because he saw something in the economy, because it had been 8 or 10 years since we had some type of a global crisis. He just said, we're due. So he had a team of us at Treasury, working with the Fed, working with the SEC, looking around for what might trigger the next crisis. And we looked at an individual bank gets into trouble. We looked at a hedge fund blows up and triggers some kind of calamity. We didn't think about a national housing bust. That was in 2006. And we were looking. And so what keeps me up at night is not all the things that are on our radars that we're looking at. We're looking at the red lights flashing. Okay, yeah, I see the red light is flashing. It's all the things that are not on our radar screen where we think everything's okay over there. If you go back to what was the root cause, in my opinion, what was the root cause of the housing bust and the financial crisis? It was a nationwide delusion that you and I participated in that home prices only go up in America. Now, we believed that different regions could have pockets of weakness. Boston might go down, but New York and San Francisco would be up, or Austin would go down and Chicago and LA would be up. The idea of a nationwide housing downturn had simply never been fathomed. And it was embedded in the models of the regulators, of the bankers, of the rating agencies, of the investors. All of their models had this fundamental assumption, unspoken assumption, underneath them. And when that assumption turned out to be wrong, it was devastating. So what keeps me up at night is, what other unspoken fundamental assumptions do we all unknowingly make that are wrong? Because that's where the next thing is going to come from, and it's very, very hard to know. Yes, sir.
Student loan debt. It's growing fast. It's hard to discharge. You can get rid of it after maybe 20 years. Is the Fed concerned that it's going to be a drag on the economy going forward?
Well, it's definitely something we pay attention to. I mean, in terms of the economic models that we've run, I haven't seen forecasts saying that this is going to be a big drag on the U.S. economy, but clearly it cannot continue to grow at unsustainable levels. And if it goes back to the earlier conversation we had about productivity growth. Part of where productivity growth comes from is human capital development. And we need to make sure that all of our people have as much education as they can get and as highest quality education as they can get. And so the debt itself, I would say, is a concern. The bigger concern is just making sure that the next generation and the generation after that are getting world-class education, because that's important for them as individuals, for their families, but it's important to all of us in terms of our overall economic performance. And if student loan debt becomes a barrier for people getting that education, then it really does become a huge problem.
The president's getting ready to announce this new tax policy over the next couple months, supposedly. And in that is repatriation tax and corporate and individual taxes getting lower. So maybe you could talk about if those proposals do get pushed through, would that concern you for inflation or overheating the economy? Or?
Well, so I've said this before publicly, which is I haven't yet adjusted my economic forecast or our bank's economic forecast with any fiscal policy changes, whether it's a fiscal stimulus, an infrastructure plan, a tax plan, only because we have no idea right now what those will be. There's a lot of stuff being talked about, but it's all over the map. And so until we can size it in some way and have some sense of here's the scale, here's the likely effect, here's how it's going to flow through the economy, it's very hard for us to make actual changes and to make any policy moves resulting from that. So we have to wait and see. Certainly, when you're near maximum employment, one has to have their eyes open that if there's a huge fiscal stimulus and you're already near maximum employment, where are these new workers going to come from? And what's it going to have? Is it just going to drive up wages and then drive up inflation? That's certainly possible. We'd have to watch that. So anything that, I think Chair Yellen said this last week in her testimony before Congress, any fiscal policy moves that they make, if they can target them towards making enhancements to productivity growth as opposed to just spending, productivity enhancing investments, there are far fewer trade-offs than we're going to have to make. Because if we can do more with what we have, we're all going to be better off. We're going to grow the pie rather than having everybody trying to compete for the same size pie. We got to grow the pie, and that means productivity enhancement. So we'd have to look at it, whether it's tax policy, if it's geared towards encouraging more investment, if it's focusing on R&D. Those are things that could be productivity enhancing over time, as opposed to just saying we're going to put more fiscal money out into the economy, which by itself could be inflationary once we reach maximum employment. Others? Yes, sir.
Talk a little bit about the velocity of money, and maybe that's tied back to the productivity growth, and what needs to happen in order to kind of speed things up a little bit.
You know, one of the big conundrums is, well, so productivity growth has been slow and investment has been weak. And you would think with very, very low interest rates, people would be out there investing. And so the big conundrum is, why aren't people investing more? Some people speculate that there are not very good investment opportunities. They're not good, even if the interest rates are very low, they're just not great projects for businesses to go and invest in. Some people say, well, no, it's just a lack of confidence, that they would be investing. Rates are low, but they don't have confidence in the political environment or in the regulatory environment. And so I think all of these things are potential reasons why productivity growth has been slow and investment has been weak. And we need to see that pick up. I mean, it's critically important. So there's been optimism since the election, right? You've seen the stock market has boomed. Some other measures in the markets have come back up. They're signaling some optimism. My gut is now they're waiting to see what actually gets enacted. You know, the president is doing some things through executive authority. Big moves need to be done with legislation, with Congress. So I think people are waiting to see, because, you know, there are big question marks. What is the Congress going to do with Obamacare? What are they going to do with tax policy? What are they going to do with immigration? These are huge, and what are they going to do with regulation more broadly? These are big things that affect almost all facets of the economy. And so I think when we get more clarity there, you'll see things start to pick up, hopefully. Yes, sir.
You talked about too big to fail and addressing that through capital requirements. Are the banks too big, or should they be forced to be smaller?
Should the banks be forced to be smaller? So part of our plan is we would create very strong incentives for the banks to decide if they really want to stay that large. You know, the biggest banks all say we have these great economies of scale and the U.S. economy benefits from them. Well, if that's true, they should be able to afford having higher capital requirements. And then they say, well, wait a second, if you put all these high capital requirements on us, our business models don't work. Well, then where are those economies of scale, right? It's a myth. And so if big banks have business models that don't work, that's not a public policy problem. That's their problem. And so basically by imposing these very high capital requirements on the biggest banks, they will have to have a tough look in the mirror and say, does our business model still work? If not, then we might decide to break ourselves up into smaller pieces that makes more sense. And they might say, for example, there might be certain business lines where there really is great economies of scale, and you could imagine a bank carving that off, capitalizing that to the high levels so that they get the benefits of scale, and then other pieces spinning them off in smaller pieces so that they're not systemically risky. I don't think that government bureaucrats should make those decisions. We're simply saying, here's the capital requirement, you decide how you meet it, and if you don't want to meet it, you decide how you want to break yourselves up. Others, yes?
You talked earlier about the things that are on your radar. I've given up worrying about the total debt of 20 trillion because it just keeps accumulating. Is that one thing that's on your radar? And what is it? What are the bad things that can happen from all that debt, or is it just not that significant?
No, it is significant, and the bigger problem than the 20 trillion is the projected path of that debt. And that comes from entitlement programs. That's Medicare, Medicaid, Social Security. And many of these programs are funded by current workers paying for current retirees. And as that ratio has gone down because our population is not growing very quickly, then all of a sudden those programs start going into the red. And if you forecast out demographics, the aging of society, and the ballooning of our entitlement programs, they're a problem that must be addressed and that someday we will have to answer for. And so it's not a problem tomorrow. It's a problem over the next decade, over the next 20 years or so. And this is totally out of the Fed's, now we're totally out of the Fed's domain. This is really about the executive branch and the legislative branch making tough choices on how to put those programs back into a sustainable path. And this is purely politics, because take Social Security. The math of how you solve Social Security is easy. You can either raise the retirement age, you can tax people more while they're working, you can change the benefits, how they grow. There are 3 or 4 levers, and then each of you can decide on your own how you would want to pull those levers. In means testing is another option. You can each decide which of those combinations of levers are optimal for you. The tough part is getting 300 million people to agree. And so, but that's ultimately what it's going to take. And so, yes, we will have to address our long-term fiscal situation, absolutely. If we don't, people will choose to invest in other countries that do. So right now, the best thing we have going for us is that we're the strongest weakling. Right? We have our own fiscal challenges, we have our own economic challenges, but investors have to come to America because we are relatively much stronger than investing in Europe or investing in Japan, et cetera, or investing in China, which has its own issues. At some point, that's not going to be the case. And so we need to take advantage of the time that we have right now to address the issues. Yes, sir.
Right over here.
Our economy getting to a 4% GDP growth, given all the optimistic things that are happening.
So right now we're at around 2% GDP growth, so real GDP growth, so net of inflation. Doubling it to 4%, it's very difficult to see how the math works. Again, it comes back to productivity growth. Right now our productivity growth, it's been about 0.5% for the past few years. It's now around 1%, the latest measurement, which is much lower than it has been historically. So somehow we have to get productivity growth up substantially, and population growth has to continue to grow. And so it's very hard to see the math work on how that could happen. I don't want to say never, I don't want to say it's impossible, but just looking at what's happening in the demographics of our country, it's very hard to see. Let's hope so, but it's not obvious right now.
It seems that the President Trump believed that he can fine-tune our current economic condition by using fiscal policy. And we all know that trade can make everyone better off, but I don't know what his idea under his current fiscal policy. I just want to hear about your opinion on his economic policy.
Well, again, we're waiting to see a lot of the details with whatever gets passed from the administration and Congress. So we don't know. I would say there's no question that our region and our nation have benefited tremendously with free trade over our lifetimes and beyond. There's just no question about that. Whether it's you and me, going to Walmart and buying things much cheaper than if we did not trade, I mean, there's just no question the benefits have been huge. Now, those gains have not been distributed uniformly around our country. And so we are learning that, hey, we need to pay attention to some of those distributional issues, maybe more than we have historically. So I think that that's part of the discussion that's going on in Washington, D.C. now. And also the question is, something I've been thinking about in light of the political environment that we're in. Our posture as a country has been, we believe in free trade, we believe in free trade, we believe in free trade. And when some of our trading partners are not as free in response, our approach so far has been, nonetheless, we're going to free trade, we're going to free trade, and eventually we hope you're going to wake up and realize that you're better off free trading too. They haven't woken up yet. And so I think a lot of people around the country are asking the question of, is our unilateral position of free trade, free trade, free trade, and lead by example, is it necessarily the optimal position? And so I think that's a fair question that we're asking as a country. And so, again, I still believe free trade, we're way better off free trading than not. But what tools do we have to make sure that other countries are also free trading? Maybe just take China as an example. I'm sure you've heard the anecdotes of a U.S. company wants to do business in China, and China says, that's fine, have a 51% JV partner in China, and we'll let you do business in China. That sounds kind of sensible. We've never done that. And so I think it's fair to ask these questions of, is this right? What's the optimal, what's the right way to do this that's fair for everybody and ends up in a better outcome for everybody?
A question about unemployment. On the surface, it seems like there's a dilemma with automation and causing unemployment. So, you know, automation increases productivity, but it could cause unemployment. So, your thoughts on that? And number two, how much do you think unemployment is a skills gap versus a lack of job creation?
So, automation is a huge part of this, and trade is taking the criticism for a lot of the job losses, but you're absolutely right. It's in many cases, it's much more technology development than it is trade that's leading to the loss of jobs, and that's not going to slow down. Right? Think about self-driving cars. Right? That's not far away. Think about self-driving trucks. Right? Now all of a sudden, I mean, being a truck driver is a tough job, but people earn a pretty good wage for hard work. And now if all of a sudden we have self-driving trucks driving all across country, that's going to have pretty profound implications for a lot of workers in America. That's got nothing to do with trade. And so it is automation, it is coming, and it's going to continue. Now, that just keeps pointing back to skills, making sure that workers have as many skills as possible. And then hopefully, so far, you know, these are issues that our country has wrestled with over a century or more, a couple hundred years. And it's like every time people predict, when people are moving from the farms to the factories, they said, oh my gosh, all this automation is putting all these farmers out of work. Well, then it led to other types of jobs, and farms became way more productive with automation. So we have to hope and do everything we can to try to have that next generation of jobs available so that when that automation comes, they're able to have the skills they need to get good jobs and still be productive members of society. But the transition is going to be very uncertain for the country and for a lot of people that it directly affects. What was the second part of your question? Yeah, so unemployment, lack of skills or lack of jobs. I hear both sides of it. So when I travel around the 9th District, I meet with a lot of small businessmen and women who say they can't hire skilled workers. You know, the famous one that everybody uses is they can't hire welders. Can't find a trained welder ready to go. So I always ask them, well, why don't you train them? Why don't you hire a young person and why don't you train them? And then they'll say to me, and I've heard this dozens of times, we can't find trainable workers. Meaning a worker who's going to show up every day at 8 o'clock, who's not on drugs, right? Who's reliable, who will be there 8 hours a day or however many hours a day. And so that may speak to a lack of basic skills that are not being acquired, that they should be acquired through elementary school, middle school, high school, so that they are then trainable in the workforce. And so I think it does come back to skills, but it also touches on some other issues that are really important and challenging as well.
Neel, question over here.
Where's over here?
Over here.
All right.
Most speakers speak for 55 minutes and answer questions for 5. You spoke for 5 minutes and answered questions for 55 minutes. It led to a very, very productive hour, and I just wanted to say thank you very much.
Oh, thank you. I really appreciate the comments.
With that, we have one more question here.
Hi, I agree. Thank you. Going back to free trade, when you talked about, of course, our going to other countries and, you know, we're doing the free trade on our side and they have not changed their mind. And do you really think they ever will? And what would it take in reality to make them change their mind?
Well,
especially China.
Yeah, I don't know. It needs to be in their interest. And so I'll give you an example. So, and I'm not an expert in this, but it won't stop me from offering an opinion. Think about intellectual property. So we know as Americans that our companies develop great intellectual property, great new technologies, and we're very concerned that those technologies are being stolen abroad. And I've heard so many anecdotes of a company says, okay, I want to do business in China. China says, okay, you need a 51% local JV partner. The US company says, okay, they do it, and then they just steal the technology, and then they create a local Chinese company based on the technology that they stole. So China steals IP, steals IP, steals IP, and as soon as China actually starts developing IP of their own, now they're going to start caring about intellectual property protections. And now there are a lot of, Scientific American had this survey a few years ago looking at where the patents are being generated. A huge percentage of patents are being generated out of China. Now I find that hard to reconcile because I can't name one thing that I can think of that's been invented in China. But eventually, China will get in the intellectual property generation business. And when they do, I bet you're going to see a transformation where all of a sudden they really do care about protecting IP because now it's on them. And now it's their developments that they're going to be worried about protecting. Now, maybe that's starting to happen now. They're giving some lip service around it. I don't know that it's happening in any big way. But all I can say to you is, at some point it'll be in their interest. Right? It's been in America's interest to benefit from free trade for our lifetimes. So it was in our interest. At some point it will be in their interest to do the same. And I don't know if that's 5 years from now or 50 years from now, but at some point it will be in their interest. And until that time, we need to use, in my opinion, all the tools that we have through the WTO and other forums to say, hey, we need fair trade for U.S. workers and for U.S. consumers. It can't just be a one-way street. And I think that's the discussion we're starting to have as a country to figure that out.
I think we have time for one last quick question right there in the front. Go ahead.
Can you talk a little bit about the health of community banks and the district, and what does their future look like,
Yeah.
especially the small guys under $500,000?
Yeah, the health of community banks in our district, what does their future look like? They're struggling right now. They're struggling. I hear about it all the time. You know, one of the perverse things about Dodd-Frank is it increased the cost of compliance, which perversely makes the benefits that big banks have even bigger. So their advantages of being too big to fail are now even bigger than they were before because they can afford to hire that extra compliance officer or that extra 2 compliance officers, et cetera, which the small banks, it's much, much tougher for them. And so they're tough. You're seeing it. You're seeing consolidation. Banks are merging. They're selling to bigger counterparts just to try to take advantage of some of these scale factors. And they serve a very important role in their communities. And so that's why I'm hopeful. I think that's, by the way, this is a nonpartisan issue. I think Republicans and Democrats both agree we need to relax some of the regulations that are smothering community banks. And I think if we can address the big banks and relax regulations smothering community banks, we can probably solve both problems at the same time. So are there buyers of what? Anecdotally, I hear about it. Anecdotally, I hear small banks are merging and are selling to mid-sized banks and to larger banks. But that's not always good for the community because a lot of times they may lose branches as a result of that, for example. Okay, well, thank you for the great questions. I really enjoyed it. I hope you found it informative. Have a great day.
Thanks, Marvin.